I think the cyclical recovery or the cyclical expansion in 2021 is a pretty widely held consensus belief. I guess you could debate the strength, but we would probably err on the side that it's likely to be stronger rather than weaker, and that should warrant a fairly pro-cyclical stance in asset portfolios. I guess the more important point for investors is, where is the risk compensation? Where is there still upside or relative value? And from our perspective, there's a couple of areas. One, we like Asian banks as a value trade. Banks in Asia Pacific trade at 0.75 times book value, 11% trend ROE, 4% dividend yield, 80% discount to US equity. We also like Asian tech versus US tech. And in the credit space, we like Asian high yield versus US high yield, which is giving you 300 basis points of additional spread compensation. So I think broadly, we've got a pro-risk stance going into, in 2021, and that should probably continue.
It's interesting you mentioned banks in Asia because of the high capital requirements. They've actually got a lot of cash sitting on the balance sheet. So you're not the only one liking the financial sector. But my question is, when you look at the environment going ahead, where is that growth going to come from? Where is that new customer base going to come from?
Well, I guess you probably have to break down Asia Pacific into a few different areas. I mean, Southeast Asia's, still got very low credit penetration compared to the developed world, very large net interest margins. So, actually, I think, you could see quite a lot of potential growth in markets like Indonesia and the Philippines, for example. But broadly, the Asia Pacific banks as a universe, which Asia Pacific, including Australia, actually have, decent balance sheets, decent trend return on equity, and trade at a pretty significant discount, and also a decent dividend yield, particularly in the context of a very low rate environment.